Hi, and welcome to the Millennial Money Canada podcast. This is episode number 23. I'm your host, Guillaume, and today I'm joined by Sam, founder of Millennial Advisors. Thank you again for listening to this podcast. And if you're a new listener, welcome to the podcast. As usual, our goal with this podcast is to elevate your knowledge about finance so that you can live well, build wealth, give generously, and leave a legacy that you're proud of at the end. Today's episode, we're going to cover the 4 most common mistakes that business owners make. There's plenty of them, but we've narrowed it down to 4. One is the decision around salary versus dividend. The other one is utilizing notional accounts. The third one is the corporate structure and leveraging the lifetime capital gains exemption. And then the fourth one is how do you design a portfolio within a corporation? But before we dive into the subject, Sam, do you want to let the listeners know what we've been up to in terms of hosting seminars and whatnot?
Yeah, for sure. So you just had a seminar last night. And we can kind of talk about that. But yeah, over the last 2 weeks, we've been putting together and building out some seminars for business owners, which kind of inspired this podcast. The 4 biggest mistakes that business owners make, that we see business owners making. And it was really cool to see. I haven't done seminars since 2019 when I wrapped up probably 4 years of doing seminars year after year after year on how to buy your first home. And I don't know, it's kind of funny because sometimes you get, I've heard this before where it's like something's worked, so we stop doing it. And it's just a weird phenomenon. It definitely worked when I was growing my business at my old firm. We would have 2-3 seminars a year. There'd be 30 to, at the highest point, 60 people that showed up for these seminars, learning how to buy their first home and all that stuff. And, it was at the time where people were saying oh, seminars are dead. There's no value in doing them because everyone just wants to Google search you. And I kind of pushed back on that. And my evidence was that it was successful. And that's actually how I built my business over my first 4 years. And so I thought to myself, when's the last time we've done an in-person event? When's the last time we got to shake people's hands, introduce ourselves, be present in our communities, because really we run a virtual practice. And I was feeling a little bit guilty that I've lived in London for 2 years and haven't picked up a single new London client since I moved here. And the one London client that I do have got in touch with me before I moved to London. And so it's kind of been one of those things where I've been feeling a little guilty about living here in the community and all that stuff and not actually reaching out and integrating myself in. So we came up with the idea to run some in-person seminars for business owners. And my event, we had about 13 people show up. And it was great. It was rented out a library and just had some coffee and donuts, and not sure if people came for that or for the actual presentation. But at the end of the day, it was great to shake hands with some local business owners, learn their stories and hear what's troubling them or things they're looking for advice on. And it was a pretty good turnout. So I'd love for you to dive a little bit deeper into yours, because you had some interesting people show up and maybe you weren't expecting.
Yeah. I know, it was great. Like you said, having an event in the community as well. I've had a few fee-only planning that I've done with people kind of around me in Victoria. And I have one client with asset under management in Victoria. But aside from that, really no one, I don't have any other clients outside that. So it's good to start building relationships, locally. And you're right. Right. There was some people who sold their businesses who came, some people who are starting their business, some people who have clients who are business owners or selling their business and, moving back to the island, and then some university students. So it was all over the place. And it actually felt awesome to, have people who are doing either a minor in business, and all the 3 of them actually were, one is computer science. The other one was mechanical engineering. And then the third one was bio something. So it was pretty cool. And then they do a minor in business, and through their entrepreneurship class, they had to attend an event locally instead of going to class this week. And then they looked up, so one of them searching on ChatGPT, give me a few events that are happening in Victoria this week. And mine showed up. And then they thought it was the most interesting among the others. So I took pride in this. I was like, oh, thank you so much. And it was cool too. I felt I was we're giving back, because I don't know ultimately what they want to do, but all 3 of them, they were really keen to learn more about, that side of being a business owner, which of course we cater to people who, not only starting their businesses, but usually they have like retained earnings, so to speak. And then this is where we can help them advise on like the most optimal situation. Right. I'm just summarizing here, but yeah, for them, it was like great knowledge, I believe. And the feedbacks were great, even though a lot of the tools and stuff we were sharing might be applicable to them, in a few years or once they actually have gone through launching a business and whatnot. And there was a business owner there that was on her third business, and which I thought was very interesting because the first two didn't go as planned, and that was, I felt, a really true representation of what going into business looks like, really, right? Like your first venture might not be as successful as you think so, right? Depending on what you're trying to start. But anyhow, so all walks of life, which made the event really interesting. So looking forward for more on that. I think I'm going to get a bit more specific into retirement planning for business owners. I think that's an angle that I would like to take going forward.
Yeah, the ChatGPT thing's fascinating. I read an article, and I think it was like a Michael Kitces article around financial advisors and ChatGPT. Can't remember if it was Kitces or someone else, but it goes to all businesses, right? Like, because it's becoming it's a huge search engine now, and because it has access to live data, like, you can type in what are the best restaurants in London, Ontario, as rated by whatever metric you want to use, and it'll pull them up. And to think that, like, if you're a business owner and you're in a specific location or you service a specific location and you can have a big enough online presence to be found in that space. And from my understanding, it goes back to like, what does your website say? What type of blogs are you posting? What type of videos are you uploading? Where all those types of things is, are you recognizable? Are you using keywords and all that stuff? And on third party domain hostings, like you posted your, and I did mine on Eventbrite, it'll scan those. So like someone searching local events in Victoria, like Eventbrite's a huge vendor, so it'll search through Eventbrite to find those, and so automatically that credibility is there, and it'll rank on ChatGPT. So that's a fascinating thing. And I don't know if people trust ChatGPT more than they would trust like a Google search or an ad that shows up, but I mean, I think they're probably getting there because it doesn't at this point, to my knowledge, prioritize based on paid searches. So like, you can't sponsor your position on ChatGPT, which is interesting. So people might trust that a little bit more too.
Yeah, I wonder what's going to happen to Google Ads, or like you said, right? Google Ads ranking or Google Ads sponsored ads.
Well, Google is using AI summaries now. Hey, so you search a topic in on Google, and then it'll come up with AI generated summaries, but then it'll link to the websites that they're taking the summaries from, and that shows up before the sponsored ads. So I don't know. I'm sure that like eventually ChatGPT is going to monetize the search engine, although I don't know how they would do that without compromising the integrity of the results. But yeah, who knows? I'm sure they'll do it, and they'll find a way. They're pretty smart over there.
Yeah, or they will integrate a ChatGPT like response, like you said. They'll expand the AI summary, which then people won't go to ChatGPT, but actually just think, that's an interesting.
I thought it was brilliant because now I'm searching a topic, and all of a sudden the summary shows up of exactly what I'm looking for. And then links, provides like a hyperlink to the actual website that it's pulling from. So again, it's like, where's your organic content on your page, right? So for us, like if we're doing keywords, blog posts, videos, those types of things, well, if we can get our stuff to show up in the AI summary, then it's game over. Because from my understanding, it doesn't pull from the sponsored content in any sort of hierarchy. I could be wrong on that, but if it pulls just from the organic content that's most clicked and most liked and most viewed, then I mean, we got to step our game up. I think every business owner needs to, when it comes to that type of promotional content.
Yeah, good stuff. Yeah. So for listeners, we didn't even advertise any of our events on the podcast. What if there were some local people that wanted to meet? Yeah, we should have done that. We'll do that in a future episodes.
But share this with your friends so that we get a bigger following, so that we have more people in more places that we can meet in person. That's our app today.
Exactly. If you found this valuable, and you are around us, whether it's London or Victoria, and we're hosting something in person, then let's meet.
We'll be hosting an event, just for the listeners here. We'll be hosting it. I'll be hosting an event in June in Toronto, not specifically for business owners. This is more for individuals working in the tech sector that are compensated via equity compensation as part of their total comp package. So stock options, RSUs, those types of things. and I'll be hosting it with a mortgage broker who we're going to talk about lending strategies. We're going to talk about unlocking your wealth, investment strategies, diversification strategies, retirement planning, all of those things. So if you are in Toronto, we'll likely be hosting it at the Well in downtown Toronto, which boasts some pretty spectacular views. So yeah, just that, definitely stay tuned for that, and we'll send that out to everyone once the event goes live.
And you said it would be like somewhat of a networking event at the same time, right?
Yeah,
So
the plan is to have other people there who complement the types of services that these individuals need. So looking at having, so I have a mortgage broker who's going to be speaking, and then we may have general insurance people there to answer any questions about home and auto, business, liability insurance, those types of things for the tech individuals who are in business. We're also going to potentially have a real estate agent for those individuals who are looking to move to buy in the Toronto market. And really, it's just going to be, I think the Well is right beside where Shopify has its headquarters, and Google and a few other big companies. And so we'll hopefully be able to provide 3 or 4 like really good contacts of people for anyone looking to get set up in these areas. So yeah, it's going to be fun.
nice. Awesome. You want to dive into this topic?
Yeah, let's do it.
All right. So mistake number one that we commonly see, and this is also somewhat of a myth, I would say, where the common thinking is that if you're a business owner, if you're paying yourself dividend, you'll be better off than if you're paying yourself salary. Why do you think that is?
Well, I think there's this like the half truth that like dividends are taxed less than salary. Some dividends are, well, okay, so we'll back up, but dividends are taxed less than salary on a personal level. So that's truth. But when you factor in like integration, it's not. But I think that people are just kind of under the impression dividends are simple. It's take an e-transfer from your business, report it as income at the end of the year, reserve some for taxes, and you're good to go. Right? Like that's really simple. There's no payroll costs. Um there's limited, like you have a bookkeeper, that it's a really simple transaction. There's no CPP, there's no EI, there's no none of that stuff, right? So I think it's really simple and easy, and I think most people have the impression that it's lower taxed, but there's some key things that they're missing from that.
Yeah. Just to elaborate a little bit on the concept of integration, I'm just looking here at the McKinsey table for integration 2025, and in BC, just to give you an example, if you earn $1,000 personally, so that would be the equivalent of salary, because when you pay yourself a salary as a business owner, it's a deduction to your corporation. So you pay less taxes corporately overall, but you pay more taxes personally than if you were paying yourself a dividend. If you're paying yourself a dividend, you'd pay more more taxes corporately, but less taxes personally, right? Because of the credit. But if you look at this example here, where you're paying yourself $1,000 at the top marginal tax rate in terms of salary, you'd be left with 465. And then if you compare that to $1,000 earned as active business income in the corporation, and you pay it out to yourself as a dividend, well, first it gets taxed at 11%, the small business tax rate. And then after that, it gets taxed at 48.9%, which is a non-eligible dividend. So net to you, you're looking at 455. So salary is slightly up by 1%. And like Sam mentioned, this is also, you need to consider that, you've creating yourself RSP room. You've also contributed to CPP, which are all key advantages that like a dividend wouldn't give you, for example.
Yeah, exactly. And I think maybe to even simplify this, just the concept of integration a little bit further is that, yeah, if you pay yourself a dividend personally from your corporation, it gets taxed twice, once at the corporate level, once at the personal level. If you pay yourself a salary from the business income that you've earned from your corporation, you're an employee of the corporation, it's treated as an expense, kind of like, how if you have employees in your business and you pay them on salary, you can deduct that salary. Well, you are technically an employee of your corporation when you pay yourself salary. So it's the same type of deduction. And then all that's left is, okay, what do I owe on my personal income? So salary is taxed once, dividends are taxed twice. And most people are under the misconception that dividends just purely tax wise are more tax efficient, but that's actually not the case in almost every province except Saskatchewan. I think maybe Nova Scotia. I'd have to double check that. But it's important to note that we're talking pure cash in pocket, pure net of taxes. There's other additional payroll costs when it comes to paying salary. And the big one is CPP, right? So when you do factor in CPP on salary, it will lower your actual cash in pocket, net of taxes, net of CPP. And so then the conversation becomes, is CPP a net benefit to a business owner, or is the money you would pay into CPP premiums better off invested on your own and used to grow your portfolio? And I had that conversation like at the seminar. I was going through this and someone very skeptically asked me, so you think that it's better to pay CPP than it is to invest that money? I think I could do better on my own. And I didn't outright say, like, you're wrong. You probably can't do better on your own, even though most people probably can't. The conversation becomes more of like, well, what's right for you? What stage of your business are you at? How much CPP eligibility do you have? Were you working at a salary in your prior career and can, live off dividends until the business hits a certain point in time? Are you 55 plus and you've taken salary all your life and now you kind of want to take dividends instead, right? There's definitely time and place where you can take dividends instead of salary and it be beneficial for you. But that's the big point of contention is, do I pay into CPP, which I have required to do if I'm a business owner paying salary, or do I pay dividends and avoid it? And that becomes a big question. I don't know. Do you have any insights on CPP? Like, what are your thoughts on like how CPP is managed and that type of stuff?
Yeah, but wait, do you remember, because I don't remember actually the exact numbers, but do you remember what the internal rate of return or that comes from the CPP that
No, I
someone
haven't.
would have to
I looked
pay?
at it like maybe 6 months ago, and the number isn't off the top of my head.
Okay, that's okay.
So I don't want to give the wrong information out on that, but yeah.
The way I had a like similar question-ish in the seminar, and the way I kind of position it in terms of the value in a way of CPP is, if you look at a business owner, again, it's case by case, but the vast majority of business owners have nothing guaranteed at retirement, all right, aside from, let's say, OAS. And in some cases, depending on, again, your sources of funding to fund your retirement at that point, it could be the sale of the business, it could be various things. If you're just banking on that, and that's going to give you way more than you need to support your needs at that point in time, then sure, you can just ignore having a guaranteed source of income and adjusted for inflation, which is what CPP provides you. But maybe this is my subjectivity in some way, having some floor, because we don't know the future, right? Yes, your exit value on your business might be 5 million, but what if it's 800,000, right? At least at that point in time, when you look at the sources of income that will help you fund your retirement, CPP and OAS, which one we just mentioned is adjusted for inflation, and it's guaranteed, which is hard to beat, again, on a portfolio. And I would have to double check the exact number you'd have to earn on your own. But you also would have to be diligent to make sure that, you're saving enough from the dividend you're paying out yourself to equate that, to make sure that you're on track to set yourself up the same way, right? Personally, which a lot of people struggle with implementation and consistency. So yeah, there's a lot of like subjective benefits there that will provide you a guaranteed floor. And the other thing too is that floor can help you take more risk with the rest of your assets, because at that point in time, let's say that CPP and OAS, depending on what it's going to look like and your standard of living, it might cover like a somewhat ish a significant portion of, let's say, your basic needs, very very basic needs. And if that's kind of almost a wash out, like, then after that you're going to need to rely less on your portfolio, which also means that you might be able to take more risk and actually end up accumulating up more wealth in the future than if you didn't have that guaranteed source of income. So, and when we look at planning, and that's what I learned also in the last couple of plans that I've done, man, as soon as you throw in some sort of guaranteed income in the plan, like, holy cow, it really brings up the funded ratio quite substantially, versus relying on assets that again have like the potential of larger drawdowns and more volatility, right?
Well, you hit the nail on the head, right? Like the managing risk part, where, and I use this example in answering the question on the seminar too, where it's like, if you had the option to have a defined benefit pension plan or a defined contribution pension plan, which one would you prefer? And by and large, people would prefer the defined benefit pension plan, because there's a guaranteed rate of income that is paid to that individual no matter what the market does, a lot of times adjusted with inflation to increase with the cost of living. And if the market drops 20% the year before you retire, that's not on you. That's on the pension provider. to continue to fund that pension. So the risk gets transferred off of you. Now, in some, very rare cases, pension plans get underfunded through bad management and things like that. Those are very rare one-off cases. But on the other hand, if you had a defined contribution pension plan, whereas you get to manage the money that you contribute and there's no guaranteed income, and all you're relying on is good investment decisions that you're making to grow that pot of money and then eventually take out an income stream that you have to determine how much is the right amount. It's not guaranteed. So who's the risk lie on? Well, it relies on you. And so as a business owner, I mean, you're taking risk in your business, right? Your business could shut down the next day from any number of things: the economy, a customer complaint, lawsuit,
Tariffs.
tariffs, yeah, like things out of your control. So you're taking a ton of risk in your business. So often these businesses have such high risk profiles. It's like, well, how are you managing your money? Are you managing your money in the same level of risk that you're taking with your business? Maybe you shouldn't be, and maybe there should be a spot for some guaranteed income building for your retirement. And the other way I look at it is like, a lot of people view CPP as a tax, and I think that's completely like a misconception of CPP, because a tax would be, something that you pay for that is then kind of redistributed for the social good, right? But CPP you pay into and you get a proportional amount back from what you've paid in. And so, CPP isn't perfect, and their fees may be creeping up a little bit too high, and there may be some valid scrutiny over the investment processes and things they invest in. But you kind of have to ask yourself, is it worth paying about $8,800 a year maximum into something that I know I'm going to get the proportional amount back plus investment that's guaranteed? It's not going to be my entire portfolio, but it's going to be a nice floor. Or is it worth, taking that $8,800 I would have instead invested in CPP, managing it myself? Do I have a good track record of knowing how to manage money? And those types of things. So I think it definitely does depend on the individual, but I wouldn't get overconfident in your ability to outperform an investment management firm like CPPI. I think it's a little bit, maybe leaning into some overconfidence, thinking that you can do better, and also with lower risk. I just don't think that's probable. I don't say possible, but I don't think that's very likely.
Yeah, no, it's like all part of, diversification, right? And if there's someone that can pull off the endowment model strategy, which that's what they use, right? The pension style model, it's them, right? The pension themselves.
Mm-hmm.
And that's also a tangent to say that everyone who's trying to mimic them at the like retail level, which is a huge sales pitch right now, right? To like high net worth clients, is like, we're mimicking those type of portfolios. Like, I would be very wary of this approach, because those like retail investment teams or retail advisory teams like don't have near any of the capabilities that the CPP of the world, the pensions have in terms of access to talent, capital,
Mm-hmm.
and whatnot, right? So
Yeah.
deep expertise.
Yeah.
So
Exactly.
yeah, cool. So what's the, in one sentence, what's the usual recommended strategy when you're talking about dividend versus salary? And that's, of course, that's a generalization here, but
Okay, so I think maybe we can split this up into two camps. So let's say individuals with established businesses that are paying themselves out maybe 150 plus a year in earnings of some capacity, whether dividends or salary. I think the evidence would suggest that paying up to the RSP limit in salary is a good way to go about it. The RSP limit is the maximum amount. You asked me for one sentence. I'm giving you way too many. But yeah, paying up to the RSP limit, which is about $180,000 salary, and funding any extra lifestyle expenses through a strategic withdrawal of dividends if there's notional account balances and things like that. I think that would be ideal. I think if you're just starting your business, I think dividends are fine. Understand that there is a kind of a CPP holiday you can take where you don't have to fund into CPP, but you can still get the max benefit. I believe it's 7 years. I'd have to double check on that. But if it takes that time for you to get your business off the ground, and you don't want to pay a salary to yourself and pay more than every dollar matters, right? Pay more into CPP than you have to, then dividends are fine. Just understand the tax implications of them.
yeah, no, that's a good thing. Yeah, I mean, there's so many factors that influence that decision, but like you said, one of them, it depends where your stages of business is at, right? If you need to keep the money in the business, you might want to pay yourself kind of like minimal amounts and then reinvest. You might not want to like create as much RSP room as you can, right? That might not be your goal at that point in time. So it just depends where, what your goals are. But yeah, like if your business is more mature and then you have more stable income, then yeah, that makes sense to start looking at, okay, where can we shelter taxes? Because that's what you're essentially doing, right? You're shifting money from a taxable account, which is your corporation, to a tax deferred account, which is an RSP, right? So if you look at like the pecking order, right, we've looked at the research, start with RSPs and TFSAs. Once that's maxed out, leave it in your corp. And then ultimately, lastly, it's personal non-registered, which is like bottom last, right?
Yeah.
So
Exactly.
it's kind of a nutshell. And that's a good segue into the types of dividends that you can pay yourself, which is mistake number 2 that we see often is clients not utilizing their notional accounts. And I would say more than that, not knowing or have never heard about, what notional accounts. Do you want to summarize them in 2 sentences?
2 sentences. Notional accounts are paper accounts or tax accounts, so they don't sit in a bank account, that create balances on them based on investment income earned inside the corporation, and taxes paid on investment income, as well as your total business income. So they're like these little accounts that can grow based on the total investment income you have in your corporation, and then they allow you to take money out of your corporation in a tax preferred way. So, I mean, I feel like I probably confused more people with that explanation than I explained. Happy to dive deeper into the different types of notional accounts, when money goes into each, and how to utilize that as an investor or as a business owner looking to optimize their investment income.
Sure, I'll have the slide here, so I'll go. So there's 4 of them, right? 1, GRIP, so general rate income pool. A second one is the CDA, capital dividend account. Third one is ERDTOH, eligible refundable dividend tax on hand, and an RDTOH, which is non-eligible refundable dividend tax on hand. For ERDTOH and RDTOH, I've made a video a few months ago when the Hakta girl, I don't know if you remember that video, right? And I made a video and I showed it in the seminar. I thought I was very clever. People were laughing. Anyways, that was just a segment there. But no, all seriousness. So the GRIP, how does it accrue, Sam?
If you earn active business income, so GRIPS, first of all, stands for General Rate Income Pool. So in the business side of active income, so income generated from like the primary business activities of your corporation, if you are in most provinces at $500,000 or under with your active business income, you get taxed at the SBD, or you get the SBD, the small business deduction, which lowers your taxable income to between 9 and 12.2%. Which is pretty good, right? Like obviously, you can earn up to 500 grand and only get taxed 12.2%. That's amazing. But anything earned over $500,000 gets taxed at between 23 to 26% ish. So that's called the general rate income tax. So there's the small business deduction, and then there's the general rate income tax. And so any income taxed at the general rate tax rate can get credited to the general rate income pool. And why this is important is because when we think about integration, we think, okay, if I'm getting taxed, let's say I'm taking out a dividend with a small business deduction, I earned $400,000 in my corporation, that money gets taxed at 12.2%. I take that money out of my corporation, that now gets taxed at whatever average tax rate it is. Those 2 tax rates combined will equal whatever the salary I would have paid myself with the deduction would equal as well. So whether I take salary or dividends, those 2 amounts would be completely equal, mostly. But all of a sudden, now we're introducing a higher tax rate in the corporation. So you think, well, now I take a dividend from that, and I still have to pay the same personal dividend tax rate plus the higher corporate tax rate. So that breaks integration, doesn't it? Well, not really, because any money that is moved into the GRIP account, which is taxed at the higher rate, is now allowed to be taken out of the corporation as an eligible dividend, which lowers the personal tax rate, maintaining the integrity of integration, because higher corporate tax rate, lower personal tax rate on eligible dividends from money from the GRIP account, versus if you're in the small business deduction limit, higher corporate or lower corporate tax rate, higher personal tax rate, and it equals out to be roughly the same.
That makes sense. Yeah. Beautiful integration here. So that's a good segue into the ERDTOH itself. So how does it accrue? Well, if you're owning, for example, shares of Canadian public companies and they pay you a dividend, that will, once you pay taxes on that, because they've already paid taxes as well, once you pay that out to yourself as a dividend, you'll be able to get a credit back to your corporation. So that's one way that eligible dividend ERDTOH is created, through the public dividends from public
Yeah.
Canadian companies.
Yeah, pop
Yeah,
quiz.
sorry.
So what's the upfront tax rate they have to pay on that Canadian dividend in the corporation?
Good question. Right.
So eligible dividends are taxed at 38% when you earn them in your corporate investment account. And that entire 38% that you pay goes to fund the ERDTOH notional account. So then when you pay that dividend out to yourself personally, you get that 38% back as a refund to your corporation.
Right.
Yeah.
Okay. And what is it for NRDTOH?
So NRDTOH is different between different types of income earned. So
Wait, how is it created? Yeah, talk about this first.
so
How's it created?
NRDTOH, the non-eligible refundable dividend tax on hand account, gives different refund rates based on the type of income that was earned. So I might get this wrong, but for example, if you earn interest income, there's, I believe, an upfront 50.17% tax in your corporation. So if you, let's just call it 50%. So if you earn $1,000 of interest income inside your corporation, you're netting $500 after paying that tax. But then if you paid that $500 out to yourself personally, your corporation would receive a refund, and I believe the refund's about 20%. Did I get that close?
I think it's 30. I'm looking in one
The
second.
30%?
Yeah, there's one part that is recoverable and one that is unrecoverable.
So the unrecoverable one happens on foreign income received. Basically, interest income received, you've got a larger recoverable refund from the NRDTOH account. But foreign income, so income from stocks you hold or interest bonds you hold abroad, like US or
European or
European
Asian,
markets, you're getting a smaller amount of that 50.17% tax you pay up front refunded to you. So when you look at from like interest income to Canadian dividend income to foreign dividend income to rental income or other income, will fall under rental. Sorry, other income covers interest and rental income. You look at those different categories, it's going to be more tax inefficient to earn dividends from foreign companies than it would be to earn interest income from or other income from Canadian companies. And so that sometimes guides people's asset allocation, which I don't think it should, because even though there is more unrecoverable taxes paid on that type of investment income, I think you would say this too as a CFA, like you don't want to sacrifice diversification and you don't want to let the tax tail wag the dog. So it doesn't mean you should invest everything in Canada because it gets taxed better, right? It just means that you have to understand how that works. When there's notional account balances, understand that if you pay that out to yourself personally in the form of a dividend, you can get that refunded to you and make sure you're optimizing those.
Yeah, no, that's a good. So just what Sam mentioned here is, for example, if you're earning $10,000 in as an eligible dividend within your corporation, 38.33% get taxed up front. But then when you pay it out as a dividend, you will get that back, right? And it's when you pay out $2.61 in dividend, you will get $1 credit back to you, right, through the ERDTOH. So ultimately, you pay no taxes. But like you just mentioned, that doesn't mean your entire corporate or holding company should be owning Canadian stocks. So you should, again, it's a blend. And even though foreign dividends are very taxed, like punitively, so to speak, because your NRDTOH doesn't credit is not as large as example like interest income or rental income or other passive income or eligible dividend, that doesn't mean you should just ignore foreign dividends as well. But if you had to make a asset location decision, then of course owning a higher proportions of Canadian stocks within a corporation or holding company, just from a tax perspective, makes more sense than other accounts. But again, you should always look from an asset allocation and diversification standpoint first, and then as a tax situation second.
Yeah. Have you heard?
Don't let the tax situation precede the asset allocation side.
Have you heard about the big beautiful bill that's getting passed in the United States?
Yeah. I've read some articles. Like I'm no tax expert, whatsoever, but pretty interesting. I don't know if you saw the increase. I would say from was it 5%, then it's going to go up to almost 50% from Canadian companies owning shares of US companies. Is that, if you read the same thing?
Yeah, so I'm not 100% sure on how much it's going to go up. I've seen different reports, but essentially, like for people who don't know, there's like a foreign withholding tax on dividends received from foreign companies. So part of the Canadian-US tax treaty. Basically, if you're a Canadian holding US stocks in a TFSA or non-registered account, then the dividends received from those US stocks will have a 15% withholding tax applied to it. And now it seems like, as a punitive punishment tax, some experts are calling it, the Trump administration is seeking to raise that foreign withholding tax, I believe, up to 35%. So from 15% to 35%. I saw it's a gradual increase. So like 5% the first year, I don't know the full scope of it, but that would be something to definitely watch for, because I think, the US is obviously a very, very successful market to invest in, and a very attractive market, especially since, 2010. But I wonder what that tipping point looks like on expected returns versus the tax implications. And now keep in mind, this is just on dividend distributions, right? It's not like capital gains or anything like that is included in this, but it is going to be interesting to watch the adoption of this and see if this actually passes and how this could affect Canadians.
Yeah. But that just reinforces the point, as well as depending on your risk tolerance as well. But if you can weather equities, then of course you should try to favor as much equities as possible into those accounts, right? And then that's going to minimize, hopefully, the amount of distributions you're getting, depending on the different sources. But then, that's. But if you look at, let's say, again, if you're a 100% equity portfolio and the total returns that you can expect from that, then you just look at the portions that will have amount of tax that is being held, which is like somewhat minimal, or it's a lot lower than, again, the expected capital gain that you're expected to realize over your lifetime. That makes sense.
I think this is a good segue into the final notional account.
Yeah. Wait, the
CDA.
Right. Yeah. Go. Yeah. Damn, I thought we could. Sure. Go ahead.
We haven't covered it yet, man.
I know. We skipped over it. Okay. That's the most important.
Oh, the most important one, and it's how all insurance policies are ever sold ever in a corporation, right?
Exactly. This is why you buy permanent life insurance.
Yeah, exactly. So let's start with the CDA account. So the CDA is an acronym for the capital dividend account. And the beauty of a capital dividend is that if there is money in your capital dividend account, then you can draw that from your corporation tax free. Now, one of the most common things when we talk about mistakes being made is that people are not aware of this account whatsoever. So, for example, if you own a manufacturing company and you sell property or a warehouse or something like that, 50% of that accrued capital gain can go tax-free into the CDA. Okay, so basically, if you sell capital property within your business, or you sell investments within your business, now there's obviously caveats to this. Like, I was talking to a home builder who home building and selling is their active business. And if you invest in a property and then sell it, that's not considered an asset that you've sold. That's considered part of your active business. So that wouldn't qualify. But for the majority of people, if they sell assets within their business, like investment or passive assets, there's a credit to the capital dividend account, which allows you to take money out tax free. Now, people sometimes think that this is a huge benefit to a business owner, but in reality, it's just equating tax fairness to someone who's like personally owning assets versus corporately owning assets. Because if you personally own assets, 50% of your capital gain is tax free. Why would it be different for business owners? Right. And so
that's good to say. Yeah.
So it's just basically equating tax fairness in your corporation personally. Now, I think an important thing to cover here is that the CRA has intended to raise the capital gains inclusion rate from 50% to a 2/3 inclusion rate. That was highly, highly unpopular and never made its way through legislation. And while not dead, is paused for now. So there's the bill hasn't like the motion, I don't believe, has been struck down because Parliament hasn't sat since like January or December, sorry. So there's been no ability to vote on it. And there isn't likely going to be a budget introduced until the fall. So that would probably be when the bill makes its formal appearance. But we've had some vague promises saying that it won't be. So we'll have to keep an eye on that. Anyways, that's a bit of a tangent. And then
would that have broken the fairness by increasing it to 66% in some ways, right? Because like if you look at like the 50% inclusion, it's the same like what you just mentioned is if you personally, if you realize that capital gains, 50% gets included, it's subject to taxes, right? In terms of inclusion. But then when you increase it to 66%, would that be kind of unfair in a way?
Well, I think it was really
Towards
punitive.
corporation?
It was really
Yeah,
punitive
exactly.
to business owners, right? Like again, it goes back to that whole, and credit to Trudeau, he's never been shy about his disdain for business owners. He's always said, like, corporations are tax cheats and they're using corporations to hide money and stuff like that. So he hasn't ever pulled his punches on business owners, and he's implemented policies that would actually like exemplify his dislike towards the ability to shelter money. And so you think of tax on split income, you think on capital gains stripping, which is gone. You think of the ability, well, mostly gone. You think of the ability to hold money in your corporations. So the idea was like, if you own capital personally, the capital gain you realize had to be over $250,000, right, in order for you to be included in the 2/3 inclusion rate. But business owners who've only paid themselves dividends and realized and had money, in their holding companies instead of RRSPs or personal non-registered assets, they would get on the first dollar to the 2/3 inclusion rate. So there was no $250,000 exemption. And so that was punitive, and it broke integration because now it made it less favorable to hold assets inside your corporation. But that was good for the government because they estimated that they could get billions of dollars in tax revenue by individuals flash selling to beat the capital gains tax rate, number one, but also pulling assets out of their corp, paying tax, and then reinvesting them personally could be another way for them to raise revenues, which they desperately needed because they were running a $60 billion deficit. So I think at the end of the day, it was a punitive measure that was very unpopular, that was also just bad tax policy. And it got, when Carney won the leadership race and then eventually the election, he made a promise that he was going to scrap it or pause it. I'm not sure what it's going to be, but at the end of the day, it's not in place now.
Mm. So that's a capital dividend account for you folks.
Well, I feel like we're missing out on the big part of the capital dividend account. Guillaume, why don't you talk about life insurance proceeds going to the capital dividend account?
But that I would not. I'm definitely not an expert, but you go. I'll let you. Yeah. Do you want to keep that for a different episode or?
Maybe. But
Yeah.
important for listeners to know, if you own life insurance inside of your corporation and there's a death claim, death of an insured individual, then as long as the policy is properly structured, the most of the death benefit goes to credit the CDA, which allows shareholders to take the money out tax free. Lots of ways this can go wrong. There's been cases.
Surprise.
Yeah. Well, I mean, even just on the structure, not even of the policy, but of the corporation on the estate plan, like there's been cases where, shareholders of the account have wanted to access the CDA, but the policy was bought on the business owner who had intended it to be a planning strategy for their kids. And all of a sudden, other shareholders who had no interest in the estate of the owner could now potentially make a claim against the CDA because they're shareholders and they wanted the money tax free. So there has to be set up right. We're not going to go in depth on it now, but CDA, yeah, pull money out tax free if there's a credit in there. If you have sold assets in your company in the past, this is always something to look at because we've seen it in the past where people come with CDA balances that they had no idea about. And, how do you want $20,000, $30,000 tax free paid out to you tomorrow, right? It's a pretty good starter of a relationship if you're coming into a new financial planning firm and they immediately notice that you've got unused CDA. So yeah.
So those are the 4 accounts, folks. CRIP, ER, DTOH, and ER, DTOH, non-eligible, and then CDA, capital dividend account. So that's a segue into another tool that, or actually another aspect of tax planning that people don't know about, and it's the lifetime capital gains exemption. So do you want to talk about, what is it in 2025? Like what are kind of the implications of the lifetime capital gains exemption? And then after that, we can talk about, what are the type of structure that would limit the use of it or basically even prevent you from leveraging it.
Yeah. So I think this is the most common thing we see with business owners is that they're not setting up their businesses with the potential to sell, even though that might be their end goal. And without, maybe some have vague knowledge of the capital gains exemption, but they don't have any in-depth knowledge. So I'm not a CPA, so I'm not going to sit up here and pretend that I'm an expert in a lifetime capital gains exemption. But there are some pretty basic things that you can learn about it from here. So in 2025, if you sell your business, the first $1.25 million of a QSBC, or a qualified small business corporation, as long as you sell the shares of that corporation, can be tax free. So even if you started the company for a nominal dollar and it's your company, you built it from the ground up, the nominal value of your shares is $1 or $100 or whatever that looks like, and you sell for 1.25 million. As long as you qualify, you won't pay capital gains tax on that $1.25 million sale. If you don't qualify, then it's treated as a capital gain because you're selling the shares of your business. So it's like selling the shares of an investment. You bought it for $1, you're selling it for 1.25 million. 50% of the difference is taxed at your marginal tax rate. So it's a huge tax savings. It could be $300,000 on that first $1.25 million exemption. So that is kind of just understanding basic structure of the capital gains exemption. You have to be a qualified small business corporation. You have to be a CCPC, or a Canadian controlled private company or corporation. And there's some other requirements as well, with like passive assets and active assets, that we don't need to dive too deep into here today. But it's important that if you're planning on potentially selling your business, that you talk to a CPA that can help you with strategies like purifying your business if it's not eligible now, redoing the structure of your business if it's currently sitting in a place where either the capital gains exemption could be partially used or not used at all, making sure the restructure is done 2 years before the sale. And if you're starting your business with selling it in mind, making sure you have the proper structure set up from early as possible to ensure that you're building towards a tax efficient sale.
Yeah, no, that's well said. And a comment as well is, even though we touch on those topics, like again, there's so many hats that we're wearing, and I know the hats that I wear well as far as financial planning. And this is a side note, but with Conquest, I've been back and forth. Now I know how to illustrate and how to allocate. The lifetime capital gains to the trust, which we're going to get in a second. And then you can, allocate this to the beneficiary so that you can multiply the LSCG. So just illustrating that in the planning side. But that's what I'm realizing, that what we're doing is, because we're working with clients who might be 5 years, 10, 15 years away from that event, our job is to identify those gaps, or those problems that will arise if there's no if there's no planning done, right? And then involving the right parties and the people who have that like deeper expertise, whether it's around tax law or around accounting, right? Tax planning from their point of view.
And
But yeah,
that's
that's
really
what I
important
realized.
to understand, right? Like, we're not sitting up here saying that, we know more than your CPA does about tax. At the end of the day, though, when we're meeting with clients, whether they have an accountant or they don't have an accountant, just because you have an accountant doesn't mean your accountant is planning for you. Doesn't even, like,
Yeah.
I talked to a guy the other day who was telling me things that were very relevant to their business. And I asked them, well, what does your accountant think? Well, I don't think he knows, was the answer. And
Yeah.
so it's not even about like, is your accountant doing a good or a bad job? It's just about the relationships and the information we have, and conversations we have with these clients go so deep that we're then able to inform the accountants of some information that they may not have even been aware of, that could influence the tax decisions. So I was even talking with the gentleman. He's a partner at a big tax firm in downtown Toronto. And I was kind of telling him how we work with clients and how we include accountants in our process, and how we're looking to expand our inclusion of accountants. And his thoughts were like, it sounds like with what you're doing about 50% of my job, which is so good, because then I can come in, and instead of having to do the full discovery, I can basically look over your plans and implement the vision, or slightly correct the vision if it needs to be corrected. But that's such a better place to start from than having someone come to you who has no clue about what they should be doing, is maybe a little hesitant to give full disclosure, tries to get you to do all the things that are maybe not the best for you, right? Like, but if they're coming through us, like if you're a client and you're like, okay, well, I need to figure this stuff out, we're kind of that first step to say, okay, here's some things you're doing wrong. Here's how we're gonna likely correct it. We'll bring the accountant in to help implement the corrections and make sure that we're not missing anything. But it starts with that.
Yeah. And also the need to plan early, like without going into too much detail, like in terms of qualifications, right? There's three tests you need to meet: the 90% asset test, 50% asset test, and then the ownership period as well. So yeah, if you're within a 2-year period, then again, that's going to put you offside in terms of claiming that capital gains, right? Which lifetime capital gains exemption, which in BC, if you do sell for 1.25 million, then your $625,000 is included to your taxes, and then you might be owing 334,375 at the highest marginal tax rates. So yeah, that's that. And then how, Sam, do we see people being offside from claiming the lifetime capital gains exemption due to their setup?
Well, I think the most common setup is the holding company owning the shares of the operating company, like owning it 100%. Um, and the holding company, so the lifetime capital gains exemption can only be claimed by an individual, right? It can't be claimed by a corporation. And so if a corporation owns the shares of another corporation, then the corporation who owns the shares can't receive that $1.25 million tax free. And so even though there is a way, so like if a holding company owns 100% of the shares of the operating company and sells the operating company, well, that's an investment of the holding company, right? So that's not like the same thing as essentially as you owning the operating company directly. It gets taxed accordingly. Now, there is a way where, if you own the holding company or if the holding company owns the operating company, you could sell both entities. But most business owners use their holding companies appropriately as holding companies, meaning cash goes in there, real estate assets go in there, shares of corporations go in there. And so, how are you going to move those holdings to you or to a different company? Well, it gets really, really complicated. And there's a pretty large tax bill you're likely going to have to face to liquidate the holdings of your holding company in order to sell both the holding and the operating company to claim the capital gains exemption. And on the flip side of that, if I'm coming in and buying a business, I don't want your holding company. I want your operating company. I want the assets inside your operating company. And as long as there's no real liability with your name or your image or your goodwill, I want the shares. I'm fine with the shares of your operating company if there's no pending liability or anything like that. And so that's really the best way or sorry, one of the common ways we see that business owners don't qualify is that their holding company owns 100% of the shares of the operating company, and often a restructure is needed 2 years prior to an eventual sale to make sure that it is eligible for that.
Yeah. And then what's the solution?
Well, you can implement a trust, right? I think that that is a very common solution, and you implement a trust where the trust owns the shares of the operating company. So you basically would roll the shares from the holding company into the operating company, and then name beneficiaries of the trust. So the beneficiaries of the trust are beneficial owners of the shares of the trust or of the shares that are held within the trust. So they can claim the lifetime capital gains exemption. And when I say they, I do mean in plurality. Multiple people can claim the lifetime capital gains exemption on one business. So it's a way, basically, the structure would look like operating company shares are owned by trust. And this is just one of the structures. There's many others, but operating company has shares owned by the trust. The trust names the business owner, the wife or husband of the business owner, and the kids or relatives or whoever as beneficiaries of the trust. And then also has a holding company as a beneficiary of the trust so that they can still preserve corporate assets and not have to pay them out personally or pay any retained earnings out personally. So any money designed to stay in the corporation flows through the trust to the holding company. And then any basically once that corporation sells, then the individuals that are beneficiaries of the trust can each claim a $1.25 million capital gain. So that is one way. That's called multiplying the capital gains exemption. So now instead of just one person getting $1.25 million, three or four people can claim $1.25 million. The money actually has to go to them, right? So that's you can't just give them the money and then take it back personally as the business owner. It does actually have to go to them. But that is a strategy that you can use to multiply and turn $1.25 million into $3 million of tax-free capital gains, or 4.5 or 6, right? Like that is a way to definitely multiply that on the sale of your business, and it can save you hundreds of thousands and sometimes even into the millions of dollars of taxes when you sell your business.
Yeah. Well, if you're, let's say, 4 people and you sell your shares for 5 million, then I just mentioned that is 334,000, per person times four. So
1.3,
that's
1.3
yeah,
something.
that's what you're looking at in
Yeah.
terms of just for by planning, right? Over
Yeah.
$1 million in tax savings by allowing you to allocate those taxable, like that portion of the taxable income to the beneficiary of the trust is extremely beneficial there, and then claim the exemption against it. That's awesome. Okay, so those are the three. I mean, the fourth one was portfolio design. That we see how people are investing. You know, the problems that we see when they invest in their corporation or their holding company. I know we're almost up to the hour here, so we could have a separate episode on this, but I will make one comment. You can also expand on this, but I would say the biggest mistake that we come across, or I've come across in the last newer clients, I would say, that are coming to us, is the amount of money that they keep in a checking account or high interest savings account, or let's say buy a GIC in their operating company, or their, maybe not holding company, but operating company. That, I would say, is because some people might not have a holding company yet, but yeah, that's the biggest thing. They're starting to accumulate retained earnings and they don't know what to do with it. Sometimes they might be fearful of investing it because they might think they might want to need the money. So depends, their situation. But lots of the time it's just they don't know how to invest it, where to invest it. And then when they invest it, that's where they make mistakes, investing in very actively fund managers who are basically realizing way more capital gains than you need to, or, training different portfolios, or maybe holding, like we mentioned already, right? How interest income and foreign dividends are taxed fairly punitively. Maybe not owning enough Canadian stocks within there, or Canadian exposures in their operating or holding company.
Yeah.
That's usually like the two main. But I would say at the basic level is people not investing the retained earnings that they have. Yeah, and then that does two things for them. So one is creating a much bigger tax bill than necessary. And second is it's actually not getting them close to their goals, especially if they have lofty retirement goals, whatever retirement means to them. They will need to be saving that amount, and then they're just losing a massive opportunity. We don't know where the market's going to go, but ultimately you need to have that money working for you and be invested if you do want to, let's say, retire early, or whatever big financial goals you may have, right?
Yeah.
Any other mistakes you see, big mistakes you see people making in their corp as it relates to their portfolio?
Yeah. So I would say like committing to long-term strategies before your business is self-sufficient is a big one too. I've seen. So if you're a new business owner and you've rightly sought out the advice of a financial advisor, and the first thing they do is to sell you a permanent life insurance policy inside of a corporation, even though you have limited cash flow. I've seen these so many times. That's a mistake I've seen. And so like those types of things, where before you are committing to any type of investment scheme or product inside of your corporation, I think there's a list of priorities that you kind of need to have down. It's like, do I have consistent profits in my like monthly in my business? Okay, check. Do I have an emergency reserve? Okay, check. Am I paying myself a living wage? Okay, check. Okay, am I maxing on my RSPs and TFSAs? Okay, check, check. All right. So now I'm in a position, I still have profits that are left inside my business. I have my emergency reserve that's in my business. So now it's like, what do I do with this extra money? And that is where you can start, where, to your point, lots of people just leave that sitting way too long. And I just don't know what to do with it. So I'm going to keep it on hand. So that becomes not only like keeping it in the wrong company, like could become a liability risk for you if that money is designated for retirement, but also just not investing at the opportunity cost of sitting on that money for 3, 4, 5 years as it grows and accumulates because of higher profits, not because of market growth. You could be losing out on very valuable years of potentially tax deferred compounding if you invest it in the right structures, or in the right portfolios that pay out minimal dividends, that are equity focused and capital gains focused. Um, there's just a lot that you could be missing out on. And I think one of the things, I was talking to you about, Guillaume, maybe a few months ago, where you were like, um, one of the biggest value adds that I've been to my clients is giving them the confidence to actually invest their money the right way. Because before that, it wasn't being invested. And just because they now have confidence and trust in me and I've been able to get them invested, I mean, that's a difference in returns of 5 to 6% a year over just sitting in cash because of the advice that I've been able to give. And so just kind of thinking about it like that level of opportunity cost is going to cost you hundreds of thousands of dollars if you're not set up right and if you're just not actioning on it because you don't know what to do. And I'll leave that with a plug. If you want to know what to do, you can get in touch with either Guillaume or myself, and we can help you navigate that. And all the links will be in the podcast notes.
Yeah, that's a great call to action. Any last comments, Sam?
I gotta go inject my dog with Cytopoint, so I gotta run.
All right.
Yeah, that's an allergy medication for those of you who don't know.
Okay, yeah,
Yeah.
no. Awesome. Well, thank you everyone for listening, and we'll see you in the next episode.